No, Allah.
Okay, so you can start. Good evening, everyone. Welcome to MSS Mentorship and Online Classes. Um, Today, we are going to officially start the financial reporting session for June 2026 examination. So, basically, based on the timetable, I'm going to share my screen now, and we are going to cover the introduction to financial reporting and the conceptual framework. Are you guys seeing my screen right? Are you seeing my screen?
Yes, sir.
Yes, yes,
Very
yes.
good. So my expectation is that I'm expecting everyone to complete the recording session as well as the notes because we only have 2 hours to do detailed explanation on the key areas, and also we are going to start solving past questions. From the notes, I've included at least 5 questions from the Kaplan kit, which we are going to solve today. So basically, we are going to start the introduction to financial reporting. We really need to know what is the purpose of financial reporting. For example, if you are talking about financial reporting as an accountant, you need to know exactly what you are going to do and what is the specific purpose for financial reporting. So basically, when we are talking about financial reporting, it's just a mere process which we can use to put together, to prepare, as well as to present the financial information. Now, it is very clear for every company, it has different operational activities. At the end of the day, we are going to present and prepare our financial statement, which will be a component of the income statement, a component of statement of financial position, a component of cash flow, the notes to account, and the statement of changes in equity. So all of this information we are going to put together, which will give us the financial statements. So now, the essence of financial reporting is for us to prepare, to put all of this financial information together, whether we are going to extract it from the system, the software the company is using, or whether we are going to do it manually, which is impossible because every organization, in one way or another, might use some amount of software in terms of preparing, in terms of data inputting, in terms of storing of financial information. So if that is the case, the process of preparing this financial information and the process of presenting, we are going to look at IES 1, the presentation of financial statements separately, is what we refer to as the financial reporting, because at the end of the year, we are expecting our key stakeholders, the investors, the bank, the lenders, the employee, we want to see how best the company has performed so far. So we can able to assess the performance of the company by presenting and preparing our financial reporting. So by preparing the financial statement and give a clear presentation is what we refer to as the financial reporting. So now it is a key part of accounting and corporate governance because with the help of financial reporting, we can able to present our financial information in separate categories. For example, if we are going to prepare the income statement, it means the objective of the income statement is for us to know the profitability status of the company, whether for that particular period the company is able to make a profit or not, because we are going to calculate tax based on that particular profit. So, with the help of the financial reporting, it can also help us to provide a transparent information and accountability, because it's very much important that the responsibility of the management is to ensure they present clear and transparent information to the shareholders. Another key part of the financial reporting has to do with the corporate governance. We are going to look at it separately, and especially when it comes to audit and assurance, because the concept about corporate governance is looking at how best the company is structured in terms of operational activities. We are going to look at the chairman, the responsibility of the chairman. We are going to look at the responsibility of the executive directors. We are going to look at the responsibility of key management employees, and also we are going to look at the responsibility of various components within the organization, looking at the audit committee, looking at the risk committee, their responsibility, their role within the organization. So basically, this is the purpose of financial reporting. And also what you need to know, we have the primary objective of financial reporting, which is basically to report on the entity performance, look at the investors, look at the lenders, look at the creditors, which the company can use to make a valuable and a strategic business decision. Later part, when we are going to look at the qualitative characteristics as well as the conceptual framework, we are going to understand whether the financial information should be useful or not. So the primary purpose of the financial reporting is to ensure we have a useful financial information which a company can use to support the decision making of X, Y, and Z company. Because the decision making can help the investors to understand how their investment is managed, can help the loan providers to be certain that the fund they provided is safe, is okay, and also the business can able to pay back their interest as well as their principal amount. So also we need to understand the users of financial statements, which are the investors, the lenders, employees, suppliers, and governments. So we don't have much to worry about it. Now, for the regulatory framework, we need to understand how and what precipitates the regulatory framework. Basically, when we are talking about the regulatory framework, we are looking at a set of rules. For example, the prudence concept on how we can account for a specific transaction, looking at the accrual concept, looking at the substance over form. Also, the regulatory framework, we are looking at the standards, looking at the IASs, looking at the IFRSs, looking at the International Accounting Standard Board. Also, we are going to look at the guidelines that govern the preparation and the presentation of financial statements. For example, as per IS1, it's clearly stated that when we are going to prepare our financial statement, we are going to show a single figure as a revenue, for example, in the statement, in the income statement, revenue figure. Then, when we are going to look at the notes to account, we are going to segregate the different components, the different revenue stream that the company is running. But when we are going to present that financial information, we are going to show a single figure in the statement, in the financial statement for revenue. Whilst to the notes to account, we are going to show a breakdown. So this is exactly what the regulatory framework is talking about because it should be in line with the IASs as well as the IFRSs. Now, the purpose of the regulatory framework is to ensure that consistency, transparency, and comparability is achieved. We need to look at one financial statement for company X, and we can able to compare that same financial statement with company Y, though they might operate in different industries, but the comparability should be achieved. And we can only achieve the comparability looking at the guidelines that govern how we should present and how we should prepare the financial statements. Also, we are talking about consistency. The approach should be consistent. We need to show a single line figure for revenue. We need to show a single line figure for cost of sale. We need a single line figure for revenue. That consistency in terms of variation of company or industry should be maintained. So that's another instance of the regulatory framework. And also, we are looking at the transparency. We need to present our financial information in a more presentable way, whereas the investors can able to understand the financial information, whether they are accountants or not. So the concept of transparency is talking about you don't need to be an accountant, you don't need to be an ACC holder before you need to understand the content of the financial statement. If the layman without any accounting knowledge should be able to understand and make meaningful information from the financial statement that the company is going to prepare. So basically, looking at all of these parameters, we need a regulatory guidelines. We need a framework. We need a system that will manage, that will help us to identify that this is the way we need to do it, and this is how we are going to do it. That's why it is compulsory when you are going to prepare a financial statement, it should be in line with IASs and IFRSs. Why? When you're going to prepare a financial statement in line with IASs and IFRSs, it will achieve the consistency. If you are a manufacturing company, or if you are a mining company, or you are a pure water company, if you are going to adopt if you are going to prepare a financial statement, you should use IFRSs and IASs, because the manufacturing company will end up achieve consistency, the mining company will achieve the same consistency, and the pure water company will achieve the same consistency, because we are going to use the single standard in the preparation and the presentation of the financial statement. Though the transaction, though the business model, though the company might not be the same, but the consistency, the transparency, and the comparability can be achieved looking at the regulatory framework. So why do we need regulatory framework? You can read that. The fundamental reason why we need the regulatory framework is to ensure that the financial statement receive a minimum amount of information, which is clear, the minimum amount of information that should be presented in the financial statement. When we are going to look at the financial statement for single entity, we are going to do it because I can remember this past March exam, it came up in the examination for single entity. So we are going to look at it when we are going to look at the consolidation as well. So now we have two different approach to the framework. We have the principle based and the rule based. So basically, we need to distinguish between the principle base as well as the rule base. Now, for the principle base, it's based on the conceptual framework, such as the International Accounting Standard. Now, when we are going to look at the conceptual framework, according to the current definition from the
You
conceptual
may
Principle
self
framework,
based,
experience the
not
same
which.
thing.
come again.
So I think you be stop. I think your internet be the malfunction just now.
Me
So
what?
I think you need for go. Yeah, you own. Make others then confirm.
Yes, it stopped for like a few seconds.
For three
So I
seconds.
think you need for go over. Yeah. So I think you need for go over the principle base.
Okay. So basically, as I was saying, the principle base is more focusing on the conceptual framework. We are going to look at it in the next section. So basically, as far as the conceptual framework is concerned, this is the backbone of all IASs and IFRSs, because whenever the International Accounting Standard Board wants to introduce, want to develop, or want to amend any accounting standard, I can remember before the IFRS 16, the leases, looking at the operating lease and as well as the financing lease. There is a major distinction between them. We are going to look at it as well. So now when the adoption of IFRS 16, it makes it very clear for us to understand what we should consider as in line with the conceptual framework. So the conceptual framework is one of the key area that you need to understand if only you want to understand any accounting standard, any implementation of any accounting standard, you need to understand the conceptual framework. Looking at the definition of an asset, looking at the definition of a liability, looking at the definition of income, expenses, and the equity. You need to understand those distinctions and you need to understand the definition. So if we are talking about the principle base, it means every implementation of accounting standard in line with the conceptual framework is what we refer to as the principle base. So now for the rule base, we have the cookbook approach. In most countries, they have different variation. That's why when you're going to sit advanced audit, you have different variation for Ireland and other countries. Even for tax, you have different variation because of the principle, the rule-based approach that is applied. So now for the cookbook approach, the cookbook approach is talking about the accounting standard are used a set of rules which company must follow. But it is also possible that the company in the company national law in the country in which the company is operating can say different thing other than what you should be using as per the IFRSs and IASs. For example, for the public sector accounting, it's talking about the IPSAs. When you're going to prepare your accounts for the public sector, you can use the IPSAs or you can use alternative approach. So that cookbook approach is what you need to understand and it's more matter. But to be precise, when you are going to look at past question, nothing much about this is coming up in the exam, but you need to aware about the principle base and you need to aware about the cookbook approach, the rule base. So now the key components you need to understand is accounting standards. I mentioned you're going to look at legislation and you need to understand the conceptual framework. We're going to look at it separately. Then also, more important, you need to know about the regulatory bodies. You need to know about the International Accounting Standard Board, which primarily responsible to facilitate and the adoption of new accounting standard. And also you need to know about the Financial Accounting Standard Board, the FASB. Then also you need to know about the SEC, the Security and the Exchange Commission. All of these are regulatory bodies. They are responsible to regulate any new accounting standard, to ensure compliance with accounting standard, to ensure all financial statements are prepared and presented in line with the IFRSs and the IASs. So for the SEC, it regulates public companies in the USA. So we don't need to worry much. You just need to know the concept for objective questions. So now these are the objectives of the regulatory framework. I've already mentioned it: consistency, comparability, and also for transparency. So basically, for the regulatory framework, that's what you need to know so far. Nothing much to worry about. So now we are talking about the conceptual framework, which is key. And I'm going to spend more time on the conceptual framework because we need to establish the link between the conceptual framework and the accounting standard. That link is very much important for your financial reporting exam, for your audit and assurance examination as well. So now, when we are talking about the conceptual framework, as I mentioned earlier, for me, it is considered to be the most important area in the whole financial reporting syllabus. Because once you have the detailed understanding of your conceptual framework, you know the definition of conceptual framework, you know the qualitative characteristics as well as the fundamental characteristics of the financial statement, then you will be able to come up with a relevant decision making for any company. So now, the qualitative characteristics of financial statement as per the International Accounting Standard Board conceptual framework. So now, when we are talking about the qualitative characteristics, these are attributes that make information provided in the financial statement useful to others. So now we need to understand what is useful information. For example, if we are talking about the trial balance, the debit and credit, we need to know which formation within the trial balance that is useful, or whether the trial balance is not useful or whether it is useful. So now what exactly the word useful is when we are talking about the financial statement? For any word that is useful, it means the company, the business should able to make meaningful and timely decision on that particular information. Now, for example, if we want to secure loan from bank, the bank will request us to provide a cash flow. The bank will request us to provide a financial statement, an audited financial statement for X, Y, and Z. Let's assume for 6 month period. So now, if there is a 6 month period audited financial statement or an approved 6 month period forecast or budgeted information that we need to submit to the bank, then the bank will assess that information if it is viable for them to provide the loan for that particular company. So now, if the bank use that document to provide the loan, it means that financial information is useful because the business has used the information to make a strategic decision, which is to secure loan, to expand, or to improve on the day-to-day operational activity. So any financial information that is useful, it is considered to be information that the company, that the entity, that the business can use to make strategic and business decisions. If the financial information cannot be used to make strategic and financial decision, it means that information is not useful. For example, the bank is requesting for 6 months. Currently, let's assume from the 1st of January to June 2026. Then the company decided to produce from the 1st of January to June 2024 or 2023. It's a 6 month period, but because of the timeliness, it is possible that the bank will not agree to provide the loan because of the information. The bank cannot use that information as a guarantee, as a guarantor factor to support that particular provision of loan. So if that is the case, then it means the financial information is not useful. So we can't place reliance on that particular information. So qualitative characteristics help the financial information useful to others. And also, we are going to split this into two. You need to know the split, you need to know the breakdown, because in most objective test question, you might be asked to segregate which particular transaction can be classified as fundamental or cannot be classified as fundamental. So now, for the useful information, we have two. We have the fundamental, then we have the faithful representation. So now, when we are talking about the fundamental characteristics, one, we are talking about relevance. Relevance can be found within the fundamental aspect. So now, if we are talking about relevant information, it means information that influence the decision making. Any information that can change, any information that can influence, any information that can shift the decision making is relevant information. Any information that can shift or that can change or that can influence the decision is what we refer to as irrelevant information. It can be a predictive information or it can be a confirmatory information. So when we are talking about predictive information, we can use a forecast. For example, the company prepare a 1 year budget, but on quarterly basis, they are going to roll the budget over to reflect the more accurate financial information because of the the current economic trend and as a result of the significant uncertainty relating to the assumption used in the preparation of the budget. So that predictive information that we are going to use, if that predictive information can influence the decision making, then we can say that predictive information is relevant to that particular decision making. Also, the confirmatory value, if certain news or information that can support the X, Y, and Z decision that is about to be made, then that decision, we can say that particular information can be influenced the decision making. So that information is relevant. Another aspect of the relevancy has to do with the materiality, which is very, very much important. For example, a company that has a turnover of $10 million, for example, then another company with a turnover of $500,000, you can't compare the impact of 500 five of 10 million of $10,000, for example, as materiality between that particular two companies, because the one with $10 million materiality of 100 $1,000 is not much as compared to the company with $500,000 and 100,000 materiality. So now we are looking at materiality based on the size of the item, or we are looking at the possibility of error. As an auditor, in most cases, you can do your materiality threshold. For example, we are going to look at how you can calculate materiality under the audit and assurance session for using for answering to audit risk questions. So basically, the materiality can be qualitative and it can be quantitative. For the quantitative, there's a threshold which you can calculate based on the asset, based on the profit, or based on the revenue, for example. So the company can decide for every for a company with 10 million turnover, you can decide that anything above 100 million or 500 million is material to the company. Anything below is not material. So when we are going to make a decision, we are going to look at these materiality parameters. And also, we are going to look at the qualitativeness of the materiality. That's why when we are going to look at related party transaction, for related party transaction, by default, according to the standard, it is qualitatively material, because if the director or the chairman has a significant relationship with one of the key management or supplier, then it is possible for ethical threats to be prevailed or for ethical dilemma to occur. So because of that, we can say certain transaction is qualitatively material rather than quantitative. So the two factors that you need to consider under the relevance has to do with the predictive and the confirmatory value as well as the materiality. Now, key information. Information is relevant if it has the ability to influence the economic decision of the user. If that information can influence, can shift, can change, can amend the decision of the users, then that information is relevant. Also, if the information is provided on timely basis, for example, we need 6 months forecast, we need 6 month financial statements to secure a loan. If that is the case, we need to have 6 months January to June 2026, we need to have that 6 months information so that it can be on time. Therefore, the bank can use it to provide the required loan. The final point, the materiality has direct impact on the relevance of information. Because some company can say, with a turnover or with an asset value of 10 million, any transaction of $1,000 is not material. And in real sense, it's not material. So basically, this is materiality threshold. You don't need to worry much about it. You can read it on your own. I'm just going to browse on the key area that you need to know. So we have talked about the fundamental. So now we are going to look at the faithful representation, which is very much important as well. When we are talking about faithful representation, it means the financial information should complete, which is key. The financial information should complete. The financial information should neutral, and the financial information should free from all material error. These three features should be present when we are talking about faithful representation. It means we need to represent the financial transaction should represent the commercial substance of the business, which is very key. So we need to present exactly what is going on within the business. If the business is currently making a loss, there is no need for the accountant to manipulate the financial information so that the company can generate a profit, which impliedly or directly, everyone knows that the financial information should present a loss for that particular period. So if the accountant decided to manipulate the financial information, it means he or she has gone against the conceptual framework, against the faithful presentation. So regardless of the situation, for example, if there's a related party transaction, according to the standard, you need to disclose all related party transaction and the notes to account. So if there's a related party transaction and the accountant did not disclose it, it means the financial statement is not faithful representation. It is not complete because you have undermined some figures. It is not neutral because you have excluded something that needs to be included within the financial statement. Then also we are talking about free from error. When you are going to implement your accounting standard, you need to ensure that you implement your standard correctly. It should free from error. So now what is completeness? Information must have all necessary description and explanation. For example, when you are going to input your financial transaction in the system, if you are talking about assets, when you are talking about capitalization of assets, but when we are going to talking about the removal of an asset, the description should be clearly stated. Capitalization of X, Y, and Z asset, depreciation of this asset, amortization of this asset, this and this. The information, the description, and explanation should be clear. The neutrality we are talking about, financial information must be free from bias. Financial statements are not neutral if the selection of the presentation of information, or we can deliberately use that information to make decision that is not fully representation of the financial transaction. As I'm talking about the neutrality, for example, the company is supposed to make a loss based on the actual financial information, but the accountant decided to manipulate some expenditure so that the company can make a profit. So you have gone against the faithful representation. Free from error at all implementation, we need to ensure that the financial information is not materially is free from material error. We are talking about materiality as well. So basically, you need to understand the content and the components of faithful representation. When you're going to look at objective test question, you can see you need to understand what is completeness, talking about description and explanation. You need to understand what is neutrality, talking about the deliberate influence or the deliberate change or deliberate misrepresentation of the financial information so that decision can be made based on information that is not correct. Then free from error, we all know what is error in terms of the implementation, in terms of your technical know-how. We need to ensure that all material error, the complete financial information is absolutely free from material error that can affect the financial statement, error that can distort the financial statement and that can reduce the decision making of X, Y, and Z company. So now we are talking about the enhancing characteristics. Under the enhancing characteristics, we are going to look at comparability. In other words, it is clear that financial statement or financial information must be comparable to another accounting period. For example, if we are talking about company A and company B, we need to be able to compare the financial statement of company A and company B. We should be able to compare the revenue of company A and company B. We should be able to compare the revenue or the cost of sale or the gross profit or the net profit, whichever situation might be. That factors of comparability should always exist. So this is what exactly the conceptual framework is talking about. We are not going to present our financial statement haphazardly, differently, because of the industry is different. No. That's why according to IES 1, we are going to present a single line of transaction within the financial statement. For example, revenue, we are going to prepare a single line. Cost of sale, single line. Expenses, single line. Profit, single line. But when you're going to look at the notes to account, there will be a detailed explanation of your revenue figure, the components of various revenue streams, the if any discount. The cost of sales also will be a detailed breakdown of the cost of sales, all the various components, the direct costs of sales, everything should be clearly stated from the notes to account. Then also, if you're talking about the expenses, it should be clear that this and X, Y, and Z are the expenses that are relating to this particular period. So by doing the fair presentation, the factor of comparability can be achieved. We can able to compare year on year. We can able to compare from one company to another. But let's assume for the same company in 20x5 or in 2024, the company use prepare the financial statement. The whole revenue is shown in the statement, the income statement, the expenses, and a lot of other things. Then, when we are talking about 2025, the same company decided to prepare the financial statement differently. Instead of using the whole revenue, the company decided to use a single revenue figure. So it will be very difficult for users of the financial statement to compare what is the exact revenue for 2024 as compared to the 2025. So that's why the conceptual framework is telling us that the factor of comparability should always be present. We should be able to compare X, Y, and Z company to another company. We should be able to compare 20x4 to 20x5 to 20x6 to 20x3. That factor of comparability should always exist. Verifiability, we are looking at the independent confirmation. We are going to check the input. For example, if we are using the Excel, we are going to check the formula, we are going to do some recalculation, we are going to do some observation process. So all of these are parameters that the conceptual framework is telling us that we need to ensure that at all costs, our financial statement is free from material misstatement. So basically, we need to look at the Excel model that we use to compute. If we are using the ERP system, whichever system we are going to use, when we are going to extract any transaction, for example, from the system, we decided to extract the fixed asset register. After we have extracted the fixed asset register, you need to do some checks and balance to ensure that the cost of the asset is clearly stated, to ensure the depreciation calculation is correct, to ensure the net book value is correct. So that checks and balance should be done. So that's what the verifiability is talking about. You need to do some calculation, you need to review your Excel model, and you need to observe some process being performed. Now we are talking about timeliness. Timeliness is more about this a specific period of time in which the financial information is available for decision making. For example, if there is a significant change, for example, the global crisis that is going on between the Iran and the United States, currently there is a significant volatility in terms of the fuel price, in terms of the crude oil and other things. So that information, if you are going to make any budget for now, you need to consider the level of volatility in terms of what you are going to put as unit cost for fuel, as unit cost for crude oil, or whichever element you need to. So that information should be considered when you are going to prepare your budget, for example. So that timeliness of information is very, very much important for decision making, because if you are going to use the old price for fuel, for example, at 24 leons, during the crisis, the fuel price has increased significantly to 35 million. So basically, you will not be able to make a strategic decision because you have understated the cost of the fuel. And the reason is because of the timeliness of the information that is available. So the timeliness is very much important when we are talking about the conceptual framework and the presentation of financial statement. Finally, it has to do with the understandability. Financial information should clearly be presented, and everyone should understand the financial statement. The user of the financial statement should understand. As I mentioned earlier, you don't need to be an accountant or an auditor before you understand the financial statement. So that understandability, we can only be able to achieve it if the financial information is presented clearly, very clearly. Single line of revenue, single line of cost of sale, single line of expenses, profitability. When we go into the asset, we need a single line for non-current asset. We need a single line for goodwill. We need a single line for impairment asset or intangible asset. We need a single line for the non-current asset. We need a single line for loans and advances. We need a single line for equity, whichever the situation might be. So that single line, if someone with no accounting background can look at the single line of revenue, well, the person can tell that the revenue has increased from 10 million to 15 million. The individual can look at the gross profit. The individual can tell that the gross profit has increased from 5,000 to 10,000. So, with the clear presentation of the financial information, decision maker can be able to understand the financial information, can be able to understand the financial statement. So, these are the enhancing characteristics you need to know: comparability, verifiability, timeliness, and understandability. Now, we are going to look at the most important area for the conceptual framework, the elements of the financial statement. So now when we are talking about elements of financial statement, we are talking about the assets, we are talking about the liability, we are talking about income and expenses, and we are talking about the residual value, the liability, the equity. So basically, the elements, these are the guys that we are going to put together to prepare the components of the financial statement. The component of the financial statement is the income statement, the statement of financial position, statement of changes in equity, notes to account, cash flow. These are the components of financial statement. So what we are going to put together to present the component is what we refer to as the element. For example, the assets, the liability, the income, the expenses, and the equity. These are the components, these are the elements of the financial statement. So now what you need to know, which is very much important for the examination and for the understanding of all accounting standards. And also for any accounting standard that we are going to cover, I'm going to link it with the definition of that particular element. For example, if we're going to cover IAS 16, which is property, plant, and equipment, which is a non-current asset in the financial statement, I'm going to link what the conceptual framework is telling us about assets to that of what IAS 16 is telling us. And according to the conceptual framework and the accounting standard, both represent the same information. Both should present the same information, which is very much important. So that link should exist between the conceptual framework and that of the accounting standard. You need to note that point down. Always there should be the link between the conceptual framework and the accounting standard. Now, for example, we are talking about leases according to IFRS 16. When we are talking about leases is a transaction or a contract that gives the right to use a specific asset for a specific period of time for a given consideration. So now looking at the content of lease, for example, someone has a property. Let's say Michael has a property. I want to use that property. Legally, Michaela owns that three-story building, for example, but I want to list that particular property. So when I'm going to when we are going to do the lease agreement, it means after the lease agreement, I, the lessee, will have the right to use the property, not the ownership, because the legal ownership of the property is with Michaela, while the right to use the property for this particular period of time is with me. So it means at that particular point in time, since I have the right to use that property, I'm going to recognize it as an asset, which is in line with the conceptual framework. Now, if we're going to look at the definition of asset from the conceptual framework, we need to know the components of the definition. Present resources controlled by an entity as a result of past events. These features should be present, and you need to understand what is present resources and what is controllability, and as a result of past events. You need to know. Now we are talking about controllability. Key concept for you to understand a conceptual framework. For you to understand the definition of an asset and the definition of a liability, you need to understand the concept of controllability. So now, what do we understand by controllability? It means that individual should have the absolute control in terms of how to demonstrate the utilization of that particular asset. As I mentioned earlier about the leases, now the lease will give the lessor the right to use the property, but not the legal ownership. So now the right to use the property will cover a specific period of time. It will cover a specific condition. For example, I'm going to use the whole of the three-story building, as I mentioned earlier. I'm going to occupy the whole of the three-story building. So if that is the case, it is not controllable if Michael had decided that, during the lease period, for this particular point in time, let's assume for 2 months, Michael has stated that I'm not going to use that property for that 2 month period. So it means for that 2 month period, I'm not going to achieve the economic benefit from the lease agreement. So if that condition is attached to that particular contract, then we can't say that particular transaction should be recognized as an asset because the concept of controllability is not available. So controllability is looking at the individual should have the right, should have the the controllable aspect of that particular property. Now, for example, if you decided to buy a car, automatically you will have all the legal documents for that particular car. So you are going to decide how and when you're going to drive the car, where you're going to go with the car. But now, if you decided to lease a car, the lessor will tell you that you don't need to drive the car from 6 p.m. to 8 p.m. or 2 hours per day. The car should park. You don't need to drive the car from this distance to another distance. For a clear example, also, if we are looking at when someone purchased a car and decided to give someone to ride that particular car for commercial purpose, the owner will tell the driver that you are going to ride from 6 a.m. to 6 p.m. Therefore, you are going to park the car in my compound. So it means the owner has the controllability because he or she can direct the utilization of that particular property, which is very much important from the definition of an asset. The owner of the asset, the one that has the controllability of the asset, should able to direct the utilization of that particular asset. If you can't able to direct the utilization of that asset, then we can't classify that asset to be a controllable asset. So that asset cannot meet the definition as per the conceptual framework. Very important. So now we are talking about economic resources. Economic resources is the right that has the potential to produce economic benefits. Now, for example, if I decided to list a property, now I'm going to list that property to finance or to support me day-to-day operational activity. So it means the economic benefit that I'm going to receive from that lease agreement, it means I'm going to do my day-to-day operational activity. I'm going to do some sales. I'm going to do some administrative tasks, which will boost and which will support my operation. So that benefit that we are going to receive, that potential benefit that we are going to receive from any asset is what we refer to as the economic resources. Alternatively, let's assume we are producing or we are doing involved in a manufacturing company. We are producing pure water, for example. If that is the case, we decided to buy a machine which can produce 10,000 pure water per day. So the 10,000 pure water that the machine can produce is what we refer to as the economic benefit because that's the reason why we decided to buy that particular machine. So now let's assume over the period of time, the production capacity of the machine has reduced from 10,000 to 9,000. So this will bring in the concept of impairment because the maximum economic resources from the utilization of that asset cannot be achieved in this particular situation. So if that is the case, we need to test for impairment. We are going to look at it separately. So what you need to know about economic resources, if we are going to purchase any asset, the basis why we are going to purchase that asset is what we refer to as economic resources. Are we guys together?
Yes, sir.
Yes, sir.
Yeah.
Very good. So now you can read further for the controllability and the past events. So also for past events, it is obviously clear there should be an existence of contract before the adoption of that asset. For instance, if you want to purchase an asset, you need to make a call that you need to call the company that I want X, Y, and Z assets. So that process is what we refer to as the past event. Situation should have been existed before the contract. So if there is no past event, then we can't recognize an asset. So there should be a present economic resources controlled by an entity as a result of past event. The present economic resources is the potential benefits that the asset will produce, and the controllability telling us that the person that has the controllability factor should exclusively direct the utilization of that particular asset. As a result of past events, we are looking at the contract, whether it's impliedly or whether it's a negating form that should exist before the purchase of the asset. So this is the definition of an asset. When we are going to look at IES 16, we are going to refer IES 16 to the present economic resources controlled by an entity as a result of past events. Also, when we are going to look at leases, we are going to link it with present economic resources controlled by an entity as a result of past events. And when we are going to look at any of the accounting standard, whether it's IFRS or IESs, we are going to link it with the present economic resources if we are talking about assets, the controllability as a result of past events. These three features should always be present before we are going to recognize or before we are going to consider to recognize an asset. So that's why when we are going to look at the recognition criteria, first among the recognition criteria, the transaction should meet the definition of that particular element. So now we are done with assets. Now we are talking about liability. Very important concept. So when we are talking about liability, it means a present obligation arising from past events which will result to outflow of economic benefits. So you need to aware about the definition of liability. There should be a present obligation. When we are talking about present obligation, it can be a legal or it can be a contractual obligation. It can be a legal or it can be a contractual obligation. Now, for example, we have an agreement with a customer to supply, or we have an agreement with supplier. For example, we want to purchase X, Y, and Z material. We have an agreement with the supplier in a written form to supply X, Y, and Z product. January. Now, if the supplier did not supply that particular product, automatically it means there's a present obligation because we have a legal agreement. The present obligation will precipitate a legal action. Now, for example, if the supplier did not supply the product, we are going to take a legal action because there's a present obligation. There's a commitment from the supplier and there's a commitment from the business as well. So if the supplier supply the product, then we have the commitment, the obligation to make payment to that particular supplier. So for liability, there should be a present obligation. And when we are talking about the word present, it means the existence, the obligation should be in existence at that particular point in time. Now, in the real situation, for example, most of the mining company, whenever they decided to install a plant or a machine in a particular environment within the community, we have what we refer to as the dismantle cost. The concept is telling us that let's assume the machine is for a purpose of 50 years. At the end of 10 years, at the end of 10 years, we need to dismantle that particular machine. We need to remove that machine from the community. So now, if there is an agreement that we need to remove the machine at the end of the year. So it means there's a present obligation for the company at the end of 10 years to dismantle that particular machine. So because of the existence of the present obligation, then we need to account for a liability. That's why when we are going to look at IAS 16, we are going to look at how we can account for the dismantle cost. But for now, we can keep it simple. What we need to know is the word present obligation, current and ongoing and existing obligation. And when we are talking about obligation, it's a commitment which it is a must for you to comply. If you have an agreement to to buy a product from a supplier, it is a must for you to buy. If you did not buy, the supplier can take you to court and you can pay damage. Also, If you have an agreement with any contractor, then if you fail to comply with that particular agreement as per the contract, then a legal action can be taken. So if that is the case, then it means there's an obligation. Also, we need to be aware that the obligation should present, it should be current, it should be in existence at the date of the accounting treatment. Another aspect of the obligation is the contractual obligation. Now, for example, in normal term, let's assume we are selling um, accessories, computers, plasmas, and so forth. Now, on normal ground, whenever someone purchases a computer, based on normal practice, we are going to provide a free maintenance for a period of 2 months or a free installation for a period of 1 month. We have been doing this over a time. So by default, most customers have the understanding that whenever we buy a product from X, Y, and Z, we can receive this particular facility. So that process, which is not illegal, but because of normal business practice, because of past experience, because of previous operation, then we can refer to that particular situation as a contractual obligation. So automatically, when there's a contractual obligation, then you need to account for your liability. Because if you fail, if you have been doing the installation of the plasma or the AC, then all of the sudden you decided to stop, the customer can take you to court. And the court will assess whether there's a contractual obligation, whether you have been doing that particular facility for that particular customer. Although within the contract agreement, we might not clearly state that we need to do the installation. So that's exactly what we mean by the contractual obligation. So it can either be a legal or it can be a contractual obligation. But whichever the situation might be, we need to assess the present obligation. That's what matters. The second point, to transfer economic resources as a result of past event. When we are talking about to transfer, it means in this situation, we are going to give out cash. We are going to make payments. We are going to give out our economic resources. We are not going to receive, but we are going to give out our economic resources, which is an outflow. Then, as a result of past event, which is the same concept, there should be an agreement before the existence of the present obligation. So, if we are talking about liability, these three features should be present. There should be a present obligation, there should be a transfer of economic resources, and it should be as a result of past events. So, you can look at the definition of obligation further, you can look at past events further. Then, when we're talking about equity, it's simple, it's just the residual interest after we have deducted the liability from the asset, nothing to worry about. So now when we're talking about income, it means anything that can increase our assets, any transaction that has the propensity to increase our assets or decrease our liability, or that can increase our equity, other than contribution from owner. We're going to look at it separately, the various um, equity elements. Don't worry about it. But now what you need to know, anything, any transaction that can increase the assets or can decrease our liability, we can account for it as an income. For expenses, any transaction that can decrease our assets. That's why when we're going to look at impairment, we are going to recognize it as an expenses because impairment is impliedly a reduction in the value of the assets. So anything that has the propensity to reduce the asset value or that can decrease the asset value or that can increase the liability, we can account for it as an expenses. That's why when we are going to look at the dismantle cost for the unwinding, we are going to debit expenses and we are going to credit the liability because we are going to increase the liability. That's why we are going to account for it as an expenses. So basically, what you need to get back of your mind and what you need to be careful of the definition of this element of the financial statement. You need to know the definition of assets heartedly. You need to know the definition of liability. You need to know the definition of equity, income, and expenses. Now, another very important area you need to know, the recognition and measurement criteria. So now when we are talking about the recognition criteria, it means we are going to look at parameters which should be used as a basis to include a transaction in the financial statement. The recognition is talking about inclusion. It's talking about putting transaction in the financial statement. That's what we refer to as recognition. For example, if the company purchased X, Y, and Z property, we are going to look at what basis that we are going to use to include that transaction in the financial statement. It's what we refer to as the recognition. The measurement is the approach which we are going to use to value that particular transaction. For example, whether we're going to use cost model, whether we're going to use the fair value model, whether we're going to use this model, whichever model that we are going to use is what we refer to as the measurement. So basically, the recognition criteria must be in twofold. When you're talking about recognition criteria, it means the information should be relevant and it should fit full representation. You can go back to the conceptual framework. Now, the key concept that you need to know. Items are only recognized in the financial statement if they meet the definition of one of the elements of the financial statement. Guys, you need to note this point down. We can only include a transaction in the financial statement if that transaction meet the definition of one of the elements of the financial statement, either asset, either liability, either expenses, either income, or either the equity. It is a must before we are going to recognize an expenses in the financial statement, before we are going to recognize liability, before we are going to recognize assets, before we are going to include any transaction in the financial statement, it is a must. It's a must that it should meet that particular category or that particular element that we are going to recognize. If it's an asset, we need to meet the definition of an asset. If it's a liability, it needs to meet the definition of a liability. If it is an equity, it needs to meet the definition of an equity. So it is a must. First condition. Also, not all items meeting definition can be recognized. Now, what is the exception to this particular situation? Why an item might meet the definition, but we are not going to recognize that particular transaction in the financial statements? For element to be recognized, it must be relevant and faithful representation. We are going to look at it when we are talking about substance over form and when we are going to relate it directly to the accounting standard. Now, for example, recognition is not relevant if there is a greater uncertainty. When we are going to look at IAS 37, right? When we're going to look at provision, contingent assets, and contingent liability, we are going to know why we are going to recognize the liability, why we are going to recognize the provision, but when it comes to contingent liability, we are not going to recognize it, we are going to disclose it. And when we are going to talking about contingent assets, we are not going to recognize it, but we are going to disclose it. But at the same time, if the contingent asset is greater than 95% that we are going to receive that particular asset, then we are going to recognize that asset. It's not a contingent anymore. So there's lots of criteria involve the accounting standard. So that's why for this level, you just need to know your definition and you need to know your recognition criteria. When we are going to look at the specific accounting standard, that's how we are going to distinguish between what meet the definition of an accounting of an element, but we are not going to recognize it, and what meet the definition of an element that we are going to recognize. So now you need to know your recognition criteria. Also, you need to know your derecognition criteria, which is very much important. When you're talking about derecognition, it means a removal of any transaction from the financial statement. For example, if we are talking about assets, we can derecognize an asset from the financial statement if we have lost control of that particular asset. Also, if we're talking about liability, we can derecognize the liability if there is no present obligation for that particular liability. Now, for example, we purchase goods on credit from X supplier, so that for X supplier, and the payment term is 1 month. At the end of the month, at the inception of the transaction, we are going to recognize a liability because we did not make an actual payment yet. But at the end of the month, when we are going to make the payment, it means we are going to offset, we are going to derecognize the liability. So when there is no present obligation, then we are going to derecognize liability. And when there is a loss of control, we are going to derecognize the asset. So basically, these are the various measurements that we are going to use: the historical base, the cost base, the fair value, and the value in use, or the fulfillment value. Don't worry about the measurement, you just need to know them, because when we are going to apply the various accounting standards, that's the time we are going to justify why are we going to use value in use, why are we going to use fair value, why are we going to use the current cost, or why are we going to use the historic cost. Now we are talking about limitation of financial statements. You need to know it as well. It usually comes up in the examination. When we're talking about limitation of financial information or financial statement, it's very clear that the information are historical in nature, because if you're going to prepare financial statement for 20x5, It contains information from 1st of January to the 31st of December 2025. So it's more about historic information. Then thereafter, we're going to prepare the financial statement in um, January, February, whichever the month may be, because we need to close the transaction at the 31st of December. So the historical information is a major limitation of the financial statement. Also, most transaction might not reflect the fair value. For example, if you're talking about the brand name, if you're talking about assets, the time you purchase the assets and the time you're going to prepare the financial statement, the fair value of the asset might change due to the current changing and business environment. So also that's a limitation of the financial statement. Finally, the judgment and estimate involved. Most accounting standard is more about judgment and it's not more about estimate and the complexity in the application and the adoption of those accounting standards. For example, if we are talking about IFRS 9, it's complex to implement in real life, very difficult. We are talking about revenue, depend on the business model. It's very difficult as well because if we are going to account for revenue for the banking industry, looking at the loans and advances, it's very difficult looking at the risks that attached to the loan and advances that is given out to customers. Also, if we are talking about the insurance company, looking at the actuarial valuation, looking at how best you can able to assert whether the insurance there will be an insurance claim or not, looking at the proceeds that will be generated from that particular insurance contract. So all of these are judgment, are estimates, are complexity. So because of all these, there are limitations to the financial statement. So basically, your takeaway point before we are going to look at the CB question, your takeaway point, you need to understand the purpose of your financial reporting, which is key. You need to understand your regulatory framework, both the principle and the rule-based approach. And also, under the conceptual framework, which is a must, you need to understand the definition of the various elements of the financial statement. Then also you need to know the characteristics, the quantitative and the qualitative characteristics. For example, under the relevance, you need to know the element. Under the faithful representation, you need to know the element. And under the enhancing, you need to know the elements that should be considered when we are talking about the enhancing characteristics of the financial information. So before we are going to the CB, the practice question, we need to, I don't know if anyone has a question that you need me to clarify for you before we are going further. Any question on what we have covered so far? Any question?
I'm outside.
Yes, sir. Somebody want to talk? I get question I will ask. Hello.
Yeah, I'm getting you.
Yeah, it's concerning the substance over form. Can you please explain me substance over form in a more simple term?
Okay. So now, when we are talking about substance over form, it means for a given transaction, we need to give more right to the substance of the transaction rather than the legal aspect of the transaction. It's really complex, but what you need to know about substance over form, I have an example anyway. I don't want to mention it because the session is under a recording. So when we are talking about substance over form, we need to give preference to certain transaction over the form of the transaction. Now, for example, we are talking about the leases, right? The lessee will have the right to lease to use that particular property. The right to use that property is what we refer to as the substance over form because the legal ownership of the property is not with the lessee but the lessor. That's an example of substance over form. Also, when we are going to look at the aspect of the the recognition of, let's assume a gain or fair value. Now, when we are talking about investment property, IES 40, part of the condition about IES 40, because of it's investment property. And when we are talking about investment property, it's a property that is owned for capital appreciation or for a gain in the fair value or for rental purpose. These three conditions will be present. So if the property is owned for a rental purpose or for capital appreciation for any potential change in the future value, then we need to categorize that particular asset as investment property. So now what the standard is saying, for example, if there is a gain on that particular property, then the standard is telling us that we need to recognize that particular gain in the financial statement directly. We need to recognize it as a gain. Whilst in other accounting standard, for example, IAS 16, if there's a revaluation gain on a particular standard, if there's a revaluation gain, let's assume upward revaluation, then IAS 16 telling us that there is no need for us to recognize the gain. We need to show the gain as other components, as other comprehensive income. And the aspect of other comprehensive income is not the same as recognizing a gain in the income statement. So now, if we are going to you look at IAS 40, which is the investment property, looking at the nature of the asset, then it means the substance which we are going to use is more over the form of the asset. So when we are going to look at accounting standard, we are going to understand more about substance over form and the prudence concept. Because for any accounting standard I'm going to explain it in line with substance over form and the prudence concept. And mostly that's why it's really difficult for the accountant to lose any legal case. Because in most cases, in several situations, the most tool that the accountant is using is a substance over form.
Okay, thank you very much.
Any other question? Any other question? Hello, guys. Are you with me?
I
Yes, sir.
guess we are okay. I
Jennifer,
think we should proceed.
Yes, sir. I'm
Famata,
okay for now.
Kenneth, are we all okay?
Yes, sir.
I'm okay.
So now we are going to solve the question. We are going to solve it as
Yeah,
a
we're good.
we are going to solve it together. So question
Okay.
one, this is from the kit. Which of the following best describe an asset under the International Accounting Standard Board conceptual framework? Also, whenever you're going to look at question, you first need to understand the question, which is very much important. And also, we need to spend 1.8 minutes per each question. We don't need to spend 2 minutes. We need to practice the time management. For any question, we need to practice the time management so that at the end of the day, the time management will be part of us. So, firstly, you need to understand the requirements. The requirement stated which of the following best describe an asset under the International Accounting Standard Board conceptual framework. Option A, an obligation to transfer economic resources as a result of past transaction. Option B, a present resources controlled by an entity that is expected to produce future economic benefits. Option C, a contribution by shareholder into the equity. Option D, an entity has a cost and can be reliably measured. So which one is the answer?
B.
Why
B.
is B?
I
B.
go with
B.
B.
Because of the control of the entity and future economic benefits.
Future economic benefits, yeah. Control and future
Yeah.
economic benefits.
Yeah.
So basically, if you don't understand the definition of assets, then you can't able to answer this particular question. That's why you need to understand every bit of the subject area. If you are talking about the conceptual framework, you need to understand detail about the conceptual framework. If you are talking about the introduction to financial reporting, you need to understand the principle based, the purpose of financial reporting. Question two, which qualitative characteristics is considered fundamental in ensuring the financial information is useful? We go again the question, which qualitative characteristics is considered fundamental in ensuring the financial information is useful? Option A, comparability. Option B, timeliness. Option C, relevance. Option D, understandability.
Go with C, relevant.
Irrelevant.
Yeah.
Very good. Well, relevance is talking about useful information. And also the comparability, the timeliness and understandability, it's under the enhancing characteristics, not fundamental. So you need to know the content of these various characteristics. Are we together?
Yes, sir.
Yeah.
Question 3. Which two of the following factors are reason why key staff cannot be capitalized as an asset, as an intangible asset by an entity? Why key staff, key employee, we cannot capitalize as an intangible asset by an entity? We need two reasons. You need to understand the question. I'm going to repeat the question again. Which two of the following? You're not going to select one, you need to select two. Which two of the following factors are reason why key staff cannot be capitalized as an intangible asset by an entity? A, they do not produce expected future economic benefits. B, they cannot be controlled by an entity. C, their value cannot be measured reliably. D, they are not separable from the business as a whole.
B and D, I think.
Exactly.
Any other alternative?
Read the C, option C, because it will be lost you.
Okay. Any other suggestion? We need to discuss.
Of-
It is better you say
Go over the options them again.
come again.
Go go over the options them again. Be the lost you.
Are you not seeing my screen?
Okay. B,
Yeah, B and D.
no, B and C.
I'll go with B and D.
B and C.
So Ibrahim is B and C for you. Okay.
Yeah.
The lady, what is your
I'll
option?
go
B
with
and D. B and D.
B and D. Any other alternative option?
I don't know, I'll go with A and C. Yeah. Right.
I think.
Okay. So now A, look at the question. Which two of the following factors are reasons why key employee cannot be capitalized? So what is the reason why we are not going to capitalize employee as intangible assets? A, they do not provide expected future economic benefit. Lie. They provide a future economic benefit because they are working for the company. They are the one that prepare the
Yeah.
financial statement. They are the one that do the day-to-day operational activity. So that is not the reason why we are not going to capitalize key employee or key staff as an intangible asset. For example, if you're working in the banking industry, if you're a cashier, then on a daily basis, you need to give out cash and you need to receive cash. So that's the benefit that you're going to provide to the company. So that's an economic benefit. So that is not the reason. B, they cannot be controlled by an entity, which is clear. We can't control the employee. Are we together?
Yes.
You
Yes,
can't
sir. Yes,
control
sir.
the
We are.
employee. It's not an asset that you can control, that you can
Yeah.
use the way you want.
Yeah.
No,
You can't control them.
you can't control an employee. So that is a reason why we cannot capitalize an employee as intangible asset. So B is one of the options. C, their value cannot be measured reliably. Their value cannot be measured reliably. D, they are not separable from the business as a whole. They are not separable from the business as a whole. They are separable from the business.
They can't. Yeah, they can be separate. So that's why B and C.
So the correct answer is B and C, because we can't measure the employee reliably. When we're going to talking about reliable measurements, for each accounting standard, there's a criteria for us to determine whether we are going to measure reliably. But it means we can't assert a financial in figure to the employee. For example, if we purchase a motor vehicle for 50,000 euros, it means we can measure the motor vehicle reliably, but that's the cost of the asset. But for employee, if you decide to employ employee today, you can't measure it reliably. So the correct answer is B and C. A and D are wrong, because A, employee can provide future economic benefits, and B, employee are separable from the business. They are not the same. Even if you're looking at the business entity concept, even the owner and the business should not be treated as the same person. There should be a separate. That's what the business entity concept is saying. That is talking about the owner. The owner and the business should be treated as separate legal entity. All costs relating to the business should be sorted out by the business. All costs relating to the owner, which is personal, should not be included in the business. That's what the business entity concept is saying. So what about employee? It is separable. Next question. Which of the following gives the best description of the objective of financial statement as set out by the International Accounting Standard Board? Which of the following gives the best description of the objective of financial statement set out as per the International Accounting Standard Board conceptual framework for financial reporting? A. We're talking about objective, to provide all information about the reporting entity that users need. B. To fairly present the financial position, performance, and changes in financial position of an enterprise. C. To provide information about the value of reporting entity to users. D. To provide information about the reporting entity that is useful to users to make decisions relating to providing resources to an entity. So which option is correct?
D.
We are looking for the best description of the objective of financial statement. Why are we going to prepare financial statement? What is the reason?
A.
Yeah, A. I got
A.
Any other option? Are we together? Fatimata, Jennifer, Michaela, are you with me?
Yeah.
Michaela,
Yes, yes, sorry.
Jennifer, are you to
What cyber adults you?
Okay. So we have option A, to provide all information about the reporting entity that users need. B, fairly present the financial position, performance, and changes in financial position of an enterprise. C, to provide information about the value of the reporting entity to users. D, to provide financial information about the reporting entity that is useful to users in making decisions relating to providing resources to an entity. So which option is correct?
I'll go with D.
Me, D.
I'll go with A.
We
I'll go
have
with
option
D.
A now, we have option B, and we have option D. Any other alternative option? So the one that selects option A, what is the reason why you decided to select option A?
Because you see, users, meaning all information needed by all users.
So what about option B? What is the reason?
For me,
Decision making, sir,
Okay, so
which
what
is
about option
vital.
D?
Yeah, decision making. That's what I'm saying.
Okay, now option A answer is within option D, and option D answer is not within option A because option A lack the aspect of decision making. So the correct answer is option D. So we cannot only report to the users, but the report information, users should be able to make strategic and business decisions. We should look at the financial statement and decided that we need to invest more, or the bank should look at the financial statement and the bank will provide additional finance, or the shareholders should look at the financial statement and also have confidence that the business is growing. Another question, which of the following statements relating to regulatory framework is or are true? 1. Accounting standards on their own provide a complete regulatory framework. B. A regulatory framework is required to ensure that the financial reporting meets the needs of account of the primary user. So which of the following statements relating to regulatory framework is or are true? Whether true or false. Option 1. Accounting standard on their own provides complete regulatory framework. Option B. A regulatory
Option
framework
one
is
is
required
false.
to ensure that the financial reporting. Come again.
Option one is false. And
Okay. What
option
about
two
okay?
is
What about option?
correct.
What about option 2?
Option two is true.
Any other alternative
Mm,
answer to this particular question?
I support
So it's clear.
option one
Because in
is wrong,
isolation,
is false, and option two is
so
true.
it's correct because in isolation, the accounting standard is not on its own provide a complete regulatory framework. Next question: the International Accounting Standard Board. The International Accounting Standard Board conceptual framework for financial reporting lists two fundamental qualitative characteristics of financial statement: relevance and faithful representation. Place the qualities listed alongside the appropriate qualitative characteristics. For example, the faithful representation and the relevance. We need to place completeness, whether it's faithful representation or under relevant. We need to place predictive value, either faithful representation or relevant. We need to place neutrality, other faithful representation or relevant. Sorry about the presentation, it's because the the system I'm using. So now for completeness, where are we going to place it? Whether faithful representation or relevant?
Faithful representative.
Okay. Any other alternative for completeness? What about predictive value?
Relevance. Yeah.
Okay. What about neutrality? What about neutrality?
Faith, faithful, faithful representation. Yeah.
So any other alternatives to the ladies?
For me, completeness should be relevance.
Okay.
completeness is relevant, predictive value, faithful representation, and for neutrality, I'm not sure.
For me, neutrality should be faithful representation.
Okay. Okay. So what make financial information relevant? What are the parameters? For faithful representation, it's talking about neutral, free from bias, and complete. Whilst relevance is talking about materiality and the information to be able to make decisions.
Yeah.
Are we together?
Yes, sir.
For faithful representation, it means the financial information should neutral, should free from error, and should complete. Those are the three parameters for faithful representation. Whilst relevance is talking about the predictive and the confirmatory value, as well as materiality. So completeness and neutrality is faithful representation, and predictive value is relevance. So finally, the International Accounting Standard Board Conceptual Framework of Financial Reporting identify Mohammed Ba. Are you with us? Mohammed Ba.
Yes, sir, I am.
Okay. The International Accounting Standard Board Conceptual Framework for Financial Reporting identifies qualitative characteristics of financial statements, which two of the following characteristics are not fundamental qualitative characteristics according to the International Accounting Standard Board. We're talking about are not fundamental. We're not talking about fundamental. Which of the following are not fundamental? Relevant, A, reliability, faithful representation, and comparability. Which two?
C is one of them, definitely faithful representation. Uh, reliability, yeah. B and C.
B, reliability, and C, comparability. Any other alternative?
C and D.
I'll go with B and D. Oh. Excuse me, sir, I have a question.
Okay.
If it is not fundamental, that means it is a regulatory framework, right?
So can we, yes, so can we identify the fundamental within this particular option?
Yes, sir.
Which are the fundamental characteristics in this
Faithful
option?
representation, faithful
The fundamental
representation and relevance.
So if you
relevance
can,
is one.
so if you can identify the fundamental, then the remaining are the correct answer. Also,
Reliability and
what you need to be
comparability.
what you need to be aware of when you are solving multiple choice question. If you understand the positive aspect, then you need to eliminate the positive, then the negative will be the answer in this particular situation, because the question is telling us that which the following characteristics are not fundamental. So if you know the fundamental qualitative characteristics, then you need to extract the fundamental, then the remaining will be the correct answer. So if the fundamental characteristics, as you mentioned, is faithful representation, and which one?
Relevance.
Relevant, then it means from your own selection, reliability and comparability is what is correct, B and C. Any other alternative? Let's discuss the issue so we can able to understand better. Any other option? Anyway, it's fine. So, okay, final question. Match. Why you need to know this approach as well? Because in the examination, you need to move
But yes,
from.
he did not tell us the correct answer.
So your answer is correct. That's why I did not mention anything more.
Okay, sir.
So the next question, sorry, is a form of drop down. In the examination, you need to move the correct answer, you place it where it should be for assets, liability, and other. So that's why you need to look at this as well. Match the elements of the correct definition according to the International Accounting Standard Board Conceptual Framework for Financial Reporting. The first definition.
Sorry, sir. Can you please scroll down to the question? We can't see. Oh, can't find the question from asking.
Oh, this is the question.
I'm still seeing the previous question that we've just answered to.
What about the network? What about
I don't
others?
know if
Are we
Nami want the
seeing
experience
match
of.
the elements,
Yes,
the form of table?
Yes,
I'm seeing match the
Yes.
elements to the
yeah,
correct
we are
Well,
definition.
we know
seeing
this.
it's the
Yeah.
network. It's the network, possibly.
But it's okay now.
Thanks. Not really. Okay, now yes.
Okay. So match the elements of the correct definition according to International Accounting Standard Board. So we need to match. The first definition, a present economic resources controlled by an entity as a result of past events. What is that?
Assets.
So we need to move the asset definition down to the asset. Are we together? Soon as you
Yes,
you
sir.
move
Yes,
the
sir.
definition from assets to assets, then this definition currently will move to the position of the assets, so the position of expenses, where we move the assets from. The second, residual interest in assets of an entity after deducting all liability.
Equity.
So we need to move
Equity.
this equity definition to the correct equity. Present obligation of an entity to transfer economic resources as a result of past events.
Liability.
So we need to move the liability to the correct portion. Then the remaining, decrease in assets or increase in liability. Where are we going to place it?
Expense.
Expenses.
The last man standing. So basically, the order will be assignments. You're going to submit it in the WhatsApp group tomorrow. So you need to solve it from this point where we stopped. You need to solve it, then we can discuss it on the WhatsApp group, because I really want to keep the WhatsApp group active as well. So generally, any other question before we can close the session for today? Any question relating to what we have covered so far? Any question?
Not for me, sir.
No, sir.
So what about the others?
For now, no, sir. No, sir.
No, I'm okay.
Okay.
Fine.
So for next week, you need to go through as per the timetable. You need to go through all the recording session, the recording videos. Then you need to read the notes, because next week we are going to crack various accounting standards. So you need to well prepared, looking at the video, looking at the concept, and try to understand, because we are going to browse through the key areas of each accounting standard that we are going to cover for the next week session. So thank you all for your time.
Thank you very much, sir.
Thank you very much.